Good afternoon, everyone, and thank you so much for joining us. Today on this call are two of my colleagues from Momentum Global Investment Management. That is Andrew Hardy and Lorenzo Laposta. Andrew and Lorenzo are going to be touching base on all things global equity, including the valuation of global equity stocks, of course, the Magnificent Seven that have really dominated the news press in quite some time now, as well as markets, to be honest. They're also going to be providing some insights from 11 of our best in class managers that we use within two of our global equity portfolios that Lorenzo will actually be touching base on at the end of the call. If you have any questions, please do post them in the chat and we'll promise to get back to you with answers as soon as possible. But hopefully you walk away with some great insights today. And with that point, I'm going to hand you over to Andrew Hardy so he can begin the more important conversation of today. Thanks so much.
Thank you, Natalie, for the introduction, and thank you everyone for joining us today. As Natalie said, I will talk about a bit of a recap of where we've come from in markets, where we see the opportunities, and how we go about accessing those through the two funds that we'll come on to talk about, our Global Equity Fund and our Global Sustainable Equity Fund. Starting off, this slide shows market returns over the last 1 year and 3 years for the major global equity regions. In blue, 1 year returns, and red, 3 year returns. The key points that I would make here is, of course, it's been a good environment overall for equity market returns over these time horizons. But the US has been dominant, particularly over the course of the last year, slightly underperforming Japan, but significantly ahead of other markets. And then the other big delta over the past 3 years to take into account is the path of US markets versus emerging markets, and in particular China within there. China has been the very significant laggard that has led to emerging markets significantly underperforming developed markets over the past 3 years. But the other big surprise here, or I think a surprise to some people, would be the performance of Japan over both of these horizons, but particularly that 3 year horizon. I think it's probably unexpected and surprising to a lot of people that Japan has actually outperformed the US market over the past 3 years. The dominance of the US market has led to the index weight becoming more concentrated as well. So much as it's interesting to look at these different regions, it's really, in developed market terms, become all about the US. In the MSCI World Index, the US now represents over 70%. Or close to 75% if you include Canada as well. Moving on, this chart looks at valuations of those different regions. The light blue line is the US and stands out as being significantly higher rated on a forward price earnings measure compared to those other markets, and indeed being elevated compared to the average of the past 10 years shown here. In contrast, other markets across the rest of the world, and indeed emerging markets in yellow there, are more in line with their 10-year average or so in terms of forward price earnings measures. We should recognise, though, that the premium applied to the US market, that blue line being, 5, 6, 7 times on a P measure higher than those other markets, or even more than that compared to the UK market. A lot of that is driven by a small cohort of stocks within the US, which we'll come on to talk about more, the so-called Magnificent Seven, those dominant mega cap tech stocks, which now represent about 30% of the US market and are driving the bulk of that higher valuation for the overall market, whereas the rest of the market, on average, is on lower valuations. What this highlights, and indeed in conjunction with the other slide, for me at least, is the benefits of an active approach, and in particular, the need for an active approach going forward from here in order to mitigate some of the risks coming about through higher valuations in parts of the market and take advantage of good return opportunities elsewhere, such as we've seen has been realised in Japan. This is a slightly tongue-in-cheek slide, but useful to talk around in terms of a few key themes that have been playing out, particularly in the US, and have driven some of that outperformance we've seen in previous years. At the top there, the US economy being propped up by NVIDIA and Taylor Swift. both relevant themes that we'll talk about a little bit here. We should bear in mind that as little as a year ago or so, there was quite widespread consensus in markets that the US economy and indeed other developed market economies would be heading into recession over the course of the subsequent 12 months or so. We've seen a technical recession in the UK, but we have certainly not seen a recession in the US. Instead, the US economy has very much surprised to the upside. I won't go into necessarily the reasons around that, but certainly one of those reasons would be the strength of the consumer that's proved remarkably resilient, supported by strong, tight labour markets and the like, but also evidenced by strong consumption across the board. And Swifties are certainly amongst those, estimated to have contributed something like 5 billion or so to the US economy over the course of the last year, a drop in the ocean compared to 22 trillion US GDP overall. But when you extrapolate that across consumption, just within the music industry and the like, and things like tickets for concerts like that being $200 plus or so, it doesn't indicate a significant weakness in the consumer. On the NVIDIA side, that's of course representative of the Magnificent Seven, which we'll come on to talk about more. NVIDIA being very much the poster child of that and riding this AI boom that started with the launch of ChatGPT in late 2022. NVIDIA has been a huge beneficiary of that, really the picks and shovels leader there in terms of the production of GPUs that are in huge demand in order to tap into the potential of generative AI. NVIDIA's profits were up some 30% last year compared to the rest of the market, which on average was down in terms of earnings. And their 360 billion or so of profits that they made represents nearly 20% of total US profits last year. The effect of this boom in AI-related stocks, then the so-called Magnificent Seven, is demonstrated somewhat here and talks to some of those earlier themes I mentioned around index concentration. On the left-hand side, we show the performance of the Magnificent Seven over the course of the last year and a bit in the dark blue line, compared to the broad US market, which is the grey line there. So over about 100% return over that time horizon for the Magnificent Seven, compared to 30% or so for the US market overall. If you strip out that Magnificent Seven, which, as I said, represents about 30% of the index, then the rest of the market has delivered a far lower return. Still very good, 20% or so, but considerably lower, highlighting just how much of that US market outperformance has been driven by a very small cohort of stocks. And then on the right-hand side, this puts the current market cap into context. So on the right, the far right, you see the company weightings within the MSCI AC World Index, which is the global index, including both developed markets and emerging markets there. So of course, the overall weighting of those Magnificent Seven is somewhat lower, but given the US is some close to 70% of that index as well, it's still there's still very high weightings, both in absolute terms and compared to historical levels of index concentration. So close to 20% in just those 7 stocks in the MSCI AC World Index, which of course is what you get if you buy a passive ETF tracker or the like. How do we put that into context? Well, on the left-hand side there, you see the total market cap of 5 countries within the MSCI AC World Index, which these 7 companies exceed. There's hundreds and hundreds of companies that are represented in those 5 bars there: Japan, UK, France, China, and Canada included. So the numbers involved here are huge in terms of the market cap of those 7 dominant companies. It is justified to a reasonable extent by profitability. These businesses are earning exceptionally high returns. Whether that's sustainable or not is a separate question that we can come on to. But we're not necessarily comparing this to a tech bubble or the like. Back in the TMT bubble of around 2000 and the like, there was more examples of companies that were on very high valuations with little to no earnings. Not exclusively, some companies were earning good money during that period as well, but attracted excessive valuations. But the point is here, we're not questioning how valuable these businesses are and how dominant they are. We see that every day in terms of how entrenched they are in our everyday personal and professional lives. but they've got very, 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 very big. Moving on, just to put, again, this into a bit more historical context. On the top chart here, we show the historical annual returns for US equity markets relative to global equities, excluding the US. Out of the 10 years shown here, in 8 years, the US has outperformed. And in many of those, it's been significant outperformance. And then on the bottom, we show the performance of large cap equities globally versus small cap equities globally. Again, in the majority of years, large caps have outperformed small caps. Part of the driver of that, a large part of that, is the large cap index being more represented by the US index and those same mega cap tech stocks. So they're not unrelated observations here. But the point is, again, large caps have outperformed smaller businesses, and particularly actually small mid cap businesses. So not large businesses, but as you go further down the cap scale, have tended to lag across most regions. This is a big driver of the trends that we see in active manager outperformance as well. So this means that it's been a tough environment for active managers to outperform in, because on average, active managers will be more diversified than an index. They'll typically be underweight the largest companies within an index. And what this is telling, and to an extent, the largest markets as well. And we've very much seen that over the course of the last few years, that a lot of global managers have been underweight the US, not necessarily because they have a negative view, but in recognition that, hey, there's 10,000 or so listed companies globally to choose from. Why do I need to put 70% of my portfolio in the US? Which I think is perfectly reasonable, and in the long term pays off in terms of diversification benefits. But that decision, even if it's only underweight in the US by 5-10% or so, because of the divergence in market performance, has had a huge impact on average returns. So it's very easy to look at active managers' performance over the last 5-10 years or so and say, active management hasn't worked, it's not worth the fees, that sort of thing. But we need to dig below that and recognise the trends that have driven that, and question, do we expect that to continue going forward? Or alternatively, is this creating a growing opportunity actually for active managers going forward from here? If we were to look at this, analyse those sort of trends for the previous 10 years, then it'd show a very different picture actually. And particularly in the noughties period up to the global financial crisis, there was a period of very strong outperformance for active managers, and indeed for small and mid caps versus large caps, generally speaking. So the point here is these trends won't go on forever, and recognise that there is a significant danger in what we term rear view mirror investing, of chasing where the markets and managers that have outperformed the most past. And then just quickly a reminder of some of the boom and bust periods, trends that we've seen over the years. The tech bubble shown at the top here, and the China bubble, as it turned out to be, on the bottom chart there. At both of these points, when those indices peaked in absolute terms, there would have been very positive sentiment towards those areas. And most recently, we very much saw that in the China period, and everyone was clamoring to invest more in China, and any valuation seemed to be okay because they were going to continue growing at much higher rates. And that's changed dramatically. It's very hard to forecast when and why that's going to change, but it highlights that there's risk when you get into these periods of euphoria and very high valuation. And coming back to the point that I've mentioned before in terms of the Magnificent Seven and the like, yes, they're very profitable. Yes, they're very dominant. Yes, NVIDIA products are in huge demand, but that should hint at some of the concerns around this area as well, in terms of there's a huge amount of interest and investment going into AI and technology and the like. And with investment, we know that drives down returns on capital, returns on equity over time. That's why ROEs tend to be a mean reverting series for companies and industries, because the more you out-earn other areas and benefit from excess profits, the more capital comes in and dilutes those excess returns down through competition. This is, I think, a useful reminder of, again, a similar sort of thing, but highlighting that over the very long term here, and here we're looking at close to 70 years or so, The largest stocks in an index tend to underperform versus the rest of the index. So here we're looking at the performance of the top 10 in the S&P 500 for the US market relative to the rest of the market, and done on an equally weighted basis to strip out the size effect within there and just isolate, well, how do the top 10 tend to do if I consistently invested in those over time. Over the very long run, you'd have underperformed by 2.5% per annum, which of course, in compound terms, adds up to a huge difference in terms of where you end up after 70 years. However, the last 10 years or so has been unusual, as you see here, with actually the top 10 outperforming by close to 5% per year. But in that 70-year context, that is unusual. Here, just highlighting the point that I've made, these stocks are on premium valuations already. There's a lot of hope priced in, and in order to make money from here, they need to deliver on that hope, or need to outperform against what are already very lofty expectations. Otherwise, you easily lose money in absolute terms or relative to the rest of the market. So here again, the blue line is the top 10 stocks and their forward PE valuation over time, with the red line being the rest of the market x the top 10. So the rest of the market here is on a reasonable valuation, 18 times or so, whereas that top 10 is 27, 28 times or so. So a huge difference in absolute terms, a high valuation as well for those top 10 in the context of longer term history. And indeed, aside from that brief COVID period, this is the highest premium for the top 10 relative to the rest of the market that we've seen since the tech bubble around 2000. And then one other point in this, just in terms of other regimes we've seen in markets over time, many of them not all tech related. We've got banking bubbles regimes, we can call them. Japan as well is an interesting one. The red line shown there, that was obviously a long time ago, in the 70s and 80s and the like. Interestingly, it was just the other week that the Nikkei finally recovered from its all-time high that it achieved back then some 34 years ago. So back then, Japan was a huge component of global equity indices. And as with these other periods, there was a lot of hope and growth priced in. A lot of those businesses have continued to do well and grown, but the price that was being paid back then was excessive. Therefore, investors have had to wait an extremely long time in order to recover from the ensuing drawdown as that bubble burst. And I think actually the other one shown here, the Nifty 50, is an interesting one to reference. Not least of all because that bubble started to inflate around the time that the Magnificent Seven original movie was released in the 60s. But that bubble continued to inflate into the 70s. And it was a similar story to what I've just articulated for Japan as well. 50 businesses that were deemed to be would be dominant going forward from here, and should be the businesses that professional and retail investors should focus on investing in. The reality is a lot of those businesses have proved super successful from there. But again, actually, investors in those around the peak of that bubble underperformed over the subsequent few decades as valuations were too high, they derated, and the rest of the market caught up. I think there's, with Magnificent Seven term being bandied about a lot now, I think it's a relevant analogy or comparison to bear in mind. The Magnificent Seven is a kind of artificial group that's been constructed in recognition of the benefit that they got from this furor around AI growing around ChatGPT in late 2022. But they're all tech and innovative, disruptive businesses in their own way, but they're all very different businesses as well, and they benefit from AI in very different ways. NVIDIA is much more of a pure play at the moment, at least, but this cohort includes the likes of Microsoft, Amazon, which is very tech-enabled, but it's also a retailing business as well, Apple, Tesla, and the like as well. And because of the more idiosyncratic nature of these businesses and different characteristics, there is divergent performance within there. They're not all going to move up and down at the same rate. However, as I've talked about already, I think it is worth focusing on them because they are proving quite highly correlated at the moment, and because they represent such a large weighting at the top of the US market. Moving on a little bit to how we go about constructing portfolios and the manager selection side of things. Here we talk about our Magnificent 11, which I've got a much higher conviction in going forward from here than I would if I was just buying into the Magnificent 7 stocks. Magnificent 11 are the 11 managers that we use across our multi-manager global equity fund and our single manager global sustainable equity fund. We've got one manager within there, Robeco, which is a quantitative manager, as Lorenzo will come to talk about, but also 10 fundamental discretionary managers, all of whom have a strong, distinct style bias, either value, quality, or aggressive growth, momentum orientated style. We've got a team of over 20 people here in the UK on our investment team, many of whom are involved in the manager research side, and we've got decades of experience of scouring the world to find the best investment managers globally. We're big believers in the multi-specialist approach that we demonstrate within these strategies. We would be, but I think there's huge advantages to come from that sort of approach in terms of scouring the world to find the very best talent globally, not assuming it's going to be based conveniently around the corner from you, nor assuming that it's necessarily going to be living within the big brand names that a lot of your clients might recognize and want exposure to. Instead, we're big believers in benefits of focus and specialization. And so that's why we pick managers with particular style disciplines. And indeed, we also pick managers with obviously a lot of experience and an established process and philosophy and the like, but also very strong alignment and focus in what they do, rather than necessarily being the big brands and big firms with huge assets under management. Instead, it's often better to find firms that are focused on doing one thing really, really well, focus the majority of their time on investment research and portfolio construction and the like, because at the end of the day, spending time speaking to clients, marketing, growing assets, all those things actually go against the generation of long-term outperformance. And it's a very tough business over the long run. It's tough to outperform the market. There's a huge amount of talent out there trying to do the same thing, and you have to build an advantage through lots of smaller factors, smaller things that go your way. And I'm a particularly strong believer that focus and alignment and hunger are key amongst those, and they're not necessarily the things that you find in the most established businesses and managers that have been outperforming for 10, 20 years and are fat and happy and less motivated to go the extra mile to uncover great opportunities. These are the 11 managers that we think are really a class apart from managers we find everywhere else. We're agnostic as to where they're based. We, as you can see here, we actually tend to find a lot of the best talent and the best characteristics amongst managers based in the US. The color coding indicates the styles. So green are our value-oriented managers, red are our growth-oriented managers, and blue is the quality-oriented managers, with Robeco in grey there being the quantitative multi-style manager. So I'll just touch on a few insights from those particular managers that we use. Here, this is from Jennison, our aggressive growth momentum-oriented manager. We've invested with them for over 10 years. They've been one of the best performing managers globally over that horizon. They're quite well known now, but back when we first invested, they were relatively little known. But they've stayed true to their style and focus, and have really delivered fantastic returns for us in our global equity fund over the period that we've been invested. They've had a very favourable market backdrop in terms of the outperformance of growth-oriented strategies, momentum and the like, but there are plenty of other managers that have had that similar tailwind who haven't demonstrated anywhere near as successful performance as they have. Thinking about more recently and the whole Magnificent 7 trend, as much as I'm skeptical about the benefits of having market-weighted exposure to those stocks at the moment, especially passive and not actively managed, we want exposure, or we want our managers to be able to take exposure to these. And naturally, given the characteristics of those businesses, that falls more on the shoulders of our growth momentum-oriented managers to be doing that. It's unlikely, not impossible, but unlikely that our deeper value-oriented managers will find opportunities in the most loved stocks globally. And that's very much the case. But so Jennison have provided us good exposure to that area. They've very much ridden that wave on the Magnificent Seven, and in particular have been big beneficiaries of NVIDIA outperformance. They've had significant overweights to that particular stock, running up to around 10% maximum weighting at times, until they cut it to around a 5% weighting more recently. So that's what we expected, and are pleased, and they've very much actively managed their positions around that. And looking back over the last few years or so, they've been particularly active around Tesla as well. They've been big bulls on that for a long time, but have cut it at times and have added a lot of value through that active trade positioning over time. But there's more going on in their portfolio than just AI and Magnificent Seven and the like. And this slide gives you an idea of some of the other themes playing out within their portfolio. Some of those are US stocks, but many of them are European as well. This next slide is focusing on a term coined by Goldman Sachs, actually, which is not one of the managers we use, but it does highlight some of the themes that are playing out within the Jennison portfolio, and indeed with some of our other managers as well. Granolas stands for that list of European stocks listed at the bottom there. And the point here is this cohort of more consumer and healthcare oriented businesses, less high tech than the Magnificent Seven, has actually performed in line with that cohort since the start of 2022. Now, admittedly, part of that is because 2022 was a very bad year for US growth tech stocks, the FANGs, using the previous acronym, but also the Magnificent Seven. And indeed, this Granolas cohort underperformed somewhat in 2024, but the journey gets you to the same place, and the journey has been much better, much smoother for the Granolas. Jennison play into some of these stocks within their portfolio. They've been long-term bulls on the luxury consumption thing, so not just general consumption, general brands, but very much the premium brands, such as your LVMH, which is included within here. And indeed, you've got significant innovation and drug success with some of the European healthcare businesses, including the likes of Novartis. And again, that's a theme that they and some of our other managers have been beneficiaries of. So the point is that there's a lot more growth out there than just coming from the AI side of things, and I think there's huge merit in not putting all your eggs in one basket, and having good diversification across the portfolio, proper diversification, not just in name and number of stocks, but in terms of the underlying growth drivers. Just coming back to the AI side of things, once again, though, this is another slide from Jennison looking at how they think about tapping into the development in AI and indeed cloud computing as well. The point here that they'll make is that actually a lot of the opportunity is still on the left-hand side here in terms of those picks and shovels and building out the infrastructure for AI, and there's less ways to play into AI as a service, which will probably be where the future is really, because businesses like ours and many others around us won't be developing their own AI and buying NVIDIA chips to do that. Instead, they'll be buying in services that are created by companies tapping into the new potential there. Nonetheless, cloud computing is very much another theme that plays out within Jennison's portfolio and indeed some of our other managers as well. And it's a key reason behind this outperformance that we've seen for AWS. There is Amazon's cloud computing division, and indeed Microsoft and Google as well. This slide, I think, is quite useful in highlighting. We're all more familiar with the cloud theme and the story behind it, but AI gives it more legs, would be the key takeaway here. And taking a step back, I think a lot of the world is still a long way away from tapping into the full potential of the cloud, let alone the cloud in a more AI-driven world here. So I think the the advent of generative AI and the like is going to accelerate the adoption of cloud services, but it'll also delay the pricing pressure that otherwise would have come through, because there's so much efficiency that can come from moving your business's servers and operating systems into the cloud. And if you want to develop AI solutions and the like, then rather than having your own monstrous computing power, it makes a lot more sense to tap into what's available through the cloud as well. Amazon, of course, is one of the dominant leaders in this area. It's been a huge driver, the dominant driver really of their returns and business growth over the past 5 years or so. And indeed, they continue to generate margins of some 29% or so for their cloud computing AWS division. And then just last slide from me before I hand over to Lorenzo here. So this looks at style factor returns. This is something that we monitor as a team on a regular basis, and just warrants a little bit of explanation in terms of what it's showing. So what we want to do is we want to monitor what's working in markets, what are the underlying risk premia, factor premia that are outworking or underperforming at any given time and across different markets. Because often it's not necessarily stock-specific risk or idiosyncratic factors that are driving divergence in returns across sectors or countries or cohorts of stocks. Instead, it's these factor premia. And it's these factor premia that we really believe in, certain ones over the long term, as being great tailwinds to build into your portfolio to be the foundations for long-term outperformance. So both of the funds that we're going to talk about focus on harnessing particularly value, momentum, and quality premia to generate their outperformance. Academic studies and proven results over time have proven that those factors over the very long run outperform if you tap into them on a consistent basis. There are periods when they underperform, but over the very long run, they tend to outperform. And indeed, value, momentum, and quality tend to be lowly to at times actually negatively correlated as well. So if they can all outperform over the long run and do so in a diversifying, relatively uncorrelated fashion, then you can, over the long run, if you blend them effectively, you can capture the long run outperformance, but with much lower volatility and lower drawdowns and lower tracking error along the way. So that's been the underpinning of our global equity fund very much since its inception, and indeed the global sustainable equity fund, but albeit achieved in a different way. So yeah, we want to tap into looking at how those different factor returns are playing out in markets. And what we show here is an analysis where, and for any one of those figures, we're looking at say book to price over 3 years. We're looking at what does the cheapest quintile of the global equity market, what has been the performance of that quintile measured by price to book relative to the most expensive quintile. And this would tell you that over 3 years, that cheapest quintile has outperformed the most expensive quintile by 4.5%. And that's based on equal weighting rather than market cap weighting to give us a more pure signal. So that's a bit of context as to what we're looking at here. I'll mention a couple of key takeaways, but also gives you an idea of how our investment philosophy and how we think about constructing those portfolios. A couple of the figures that I think jump out here and warrant some highlighting is this point that although it feels like growth has outperformed value for a long time now, forever almost, actually it's only been more recently over the past year that's been clearly evident in factor returns. And when you look over 3 years, actually growth has not outperformed, it's underperformed. Instead, look at that bottom one, it's size, it's mega caps that have really driven that outperformance. It's that Magnificent Seven and the like. And so one of the other takeaways is hey, actually growth stocks that have been growing faster than the market have been derating, getting cheaper outside the Magnificent Seven on average. So whilst we think that the Magnificent Seven deserves some exposure, and there's some potential opportunity in an actively managed portfolio going forward from here, there's actually potentially much more opportunity outside the US and indeed in small and mid caps, where we think there's very good opportunities for active managers going forward from here. So with that, we'll hand over to Lorenzo.
Thank you, Andrew. We've talked about the US a lot, and quite rightly so, because it's a massive market and it's a very important one, and certainly is getting a lot of media attention. But the reason why we invest globally is because the globe is made of hundreds of countries, of thousands of stocks, tens of stock markets we like to access. And the US is overcrowded also from an analyst perspective. You see on screen the percentage of stocks in each of these regions split over the number of analysts that are covering them. And in the US, more than 70% of stocks have 3 or more analysts looking at them, which tells you that there is very little information that is not being shared and uncovered, which is not great for active managers. It means that probably the pricing that you see on the market is pretty efficient. However, other regions are not as widely covered as the US. Look, for example, at Japan, where we see the thing reversed to some extent. 74% of the market has 0 or only 1 analyst covering the stocks at best. And why is that? Well, Japan has been a very unexciting market for a very long time. We went through 2 decades of low economic growth, of deflation, of poor returns. So, most people just stopped investing in Japan. Why bother when the US is delivering so nicely? But we've seen how things can revert quite quickly. And, a stock market like that, made of almost 4,000 stocks, it's probably going to offer very good opportunities for active investors, especially when there is very little coverage of those. And that's precisely where Moore & Wright are benefiting from, let's say, because Moore & Wright is one of the Magnificent 11 managers that Andrew just mentioned. They have been investing in Japanese equities for about 20 years. They know the market inside out. And they've lived through all of the crises we've seen. They lived through changes, through good and bad times, and that gives them an edge to focus on those perhaps 74% of the market that are not being covered by anybody, and by next generation of winners. These you see on screen is performance of the strategy we own within our global equity fund over the last 2.5 years, pretty much ahead of benchmark and ahead of Japanese benchmark as well. And Japan is going through a whole transformation, really. It's been 12 years since former President Shinzo Abe came up with a series of reforms trying to making Japan a better country from a shareholder perspective, making companies better and more interesting for global investors, trying to push dividends up, trying to push shareholder returns up through share buybacks. And we've seen last year, actually, the central bank and the Tokyo Stock Exchange naming and shaming companies that are sitting on piles of cash without distributing that to shareholders, which has been a very common habit in Japanese stocks for a couple of decades. But now things are changing. We've seen Japan performing really well last year. Over the last 3 years as well, it's been a strong performer. And these markets are markets you wouldn't see if you weren't actively looking for them. They are a small part of your global equity benchmark, and most times managers don't understand Japan in detail. Is very particular and is a large market. But with the right managers, with the right magnificent managers, you can access that. And it's not just about regional opportunities, it's also about stylistic opportunities. Andrew mentioned how much we also like value as a style, and we own a few managers within this 11 long list that employ a value style when investing. One of those is Artisan. We've been investing with them for a long time. It's one of the first managers that we included in the Global Equity Fund. And you see on screen that they don't own the Magnificent Seven, they own the Global Value Seven, which are equally famous names. And actually one of them would be also a Magnificent Seven, that being Alphabet. But they own Samsung, UBS, Novartis, big names you would know. And as much as they don't get enough media attention as the Mag 7, they still offer pretty decent returns. There is plenty of numbers on screen, but I would focus on 3 or 4 lines. The Global Value 7 offer a 2% higher dividend yield than the Magnificent 7. That they are more diverse from a sector perspective, which means less concentration, lower risk. They trade at a valuation of 15 times price to earnings, which is about a third that of the Magnificent 7. And they offer a 12% estimated 3-year growth compared to 19. So slightly lower, well, it's 2/3, but a much lower valuation. So the expected return on that portfolio is actually higher, as much as I don't think many people would prefer investing in Danone compared to perhaps an Amazon. Exactly for what Andrew mentioned, it's all about profitability. The Mag 7 are great companies, but great companies don't necessarily make great investments. A great investment is one where you pay little for something that is worth a lot, effectively. And markets are starting to realize that. The shaky line you see on screen is an index that is compiled by the CBOE, and is the S&P 500 dispersion index, and it measures a market expectation of how much performance of the S&P 500 components will diverge in the coming 6 months. So a high number tells you that markets are expecting a lot of variability in market returns, and a low number means they expect everything to be pretty much in the same range. And a high number is very good for active investors. It means that there'll be plenty of stocks doing well and plenty of stocks doing terribly, and that's when being selective actually pays out more, increases the breadth you can take advantage of. And by running a portfolio of 50 names or even 100 names against a benchmark of 500 or 1,000 can really make a significant difference. Managers that typically benefit from breadth would be quantitative managers, those that generate outperformance by looking at a large variety of data and buying a large variety of stocks, and give you exposure to rewarded styles like momentum, value, quality, size that have been mentioned before. And in particular today, when data availability is impressive, these core managers can really thrive. Today, we have about 175 billions of terabytes data available. It's a huge number. I don't know how many zeros are there, but many. But the impressive thing to me is that number, it's about 3 times higher what it was 5 years ago, and it grows pretty much at a 3 to 4 times growth rate every 5 years. So it's exponential, and that means that the number of data we can take advantage of to generate our performance is more and more, and that's where core managers are really useful. It's no longer just about analyzing a bunch of balance sheets and attending earnings calls, but it's also about using machine learning techniques or natural language processing to analyze live data available on the internet, in media reports, looking at satellites information of cars parked at shopping centers, for example, to get a gauge of net sales. There is a whole world of data that these managers can take advantage of, and that certainly gives them an edge. But most importantly, the reason why we like quant managers is because they are very different from fundamental managers. And the two things blend together pretty nicely. You see on screen what's the distribution of expected returns of quantitative managers in blue and fundamental managers in gray. Don't worry too much about numbers, but look at the pink line, a 50-50 blend of fundamental and quantitative managers. You see that the peak is on the right-hand side of both quantitative and fundamental curves, which tells you that the expected information ratio, so the amount of active returns per unit of risk, is much higher if you blend fundamental and quantitative as opposed to just having one of the two. And that's because blending helps, diversification helps, and two very different approaches that are equally good in terms of expected returns actually diversify each other pretty nicely. So let's bring all of these together. We've covered many themes and styles and managers, but how do we go about that? How do we play that within our funds? The Global Equity Fund is our long-standing flagship diversified solution within the space. Its best ideas is style diversified. You see on screen all of the managers we mentioned and a few more. We try and be diversified across the key styles, quality, value, and growth or momentum. And we do so with a few managers within each sleeve. That provides a very stable solution, something that I'm going to borrow a very common wording and call it all weather, because that's what it is. Values and growth and quality stocks don't all perform well at all times. Styles also are cyclical, and they correlate with each other to some extent. So by having a combination of them helps you in keeping returns stable and consistent over the long run. We don't shy away from taking bold position and different positions from benchmark. This chart you see on the screen is a visual representation of the 11 managers we have. And the sort of gold bubbles would be MSCI All Country World Index as a benchmark. I believe that's the value one. Besides the central part of this chart would be a blend MSCI World type exposure, and all the bubbles represent one of the managers and how they position themselves in terms of large, mid, or small cap exposure or value, blend, and growth. And you see that they are all over the place on purpose. We like to have extreme managers from a Jennison, the sort of dark green, bluish bubbles on the top right that invest in mega cap aggressive growth managers, all the way down to a contrarius that instead focuses on mid cap value managers, or a paradise that goes even further down the small cap scale. And by blending them, we end up in a nice central spot. You see that dark purple line being the Global Equity Fund, which is style diversified, but also has very concentrated and high conviction positions within itself, aimed at delivering long-term returns. And don't worry, we own some of the Magnificent Seven. We're not that crazy. So you see on screen how much each of the managers has owned of the Mag 7 of the last 3 years. Jennison, the dark line on top, has been the highest owner of those, ranging between 20 and 30%. They have been taking some of that off after the very strong returns they've seen and just reinvesting profits elsewhere. All the other managers have been maybe slightly underweight, like in Morgan Stanley's case, to very underweight, as in Robeco, often contrarius, Sands especially. The overall exposure would be probably some 10%, pretty much, so half the benchmark weight in those, which we feel being fair given the concerns we have, even though, again, we realize it's great stocks, and you want to have some of those still within your portfolio. But maybe even the most aggressive growth manager we own is being reducing the exposure there. So that tells you that risks in those cohorts are increasing. We have a few slides on the portfolio composition, but I'm gonna just maybe gloss over them. Just highlighting on this maybe that the overall portfolio is diversified across 650 names, 11 managers, 3 styles. An active share of typically 60 to 70% is slightly lower right here, but over the long run, you can expect a reasonable degree of activeness from it. And it's changing time. It's 15 years old as a strategy. So obviously that changes. The long-term performance is solid, in my opinion. Against peers in particular, we have consistently delivered outperformance. You see the green bars being the fund, and the red bars being the P group median. So well ahead of that. We have lagged the benchmark in recent times, especially over the last 3 to 5 years, because of our underweight to the US mega cap growth names. But previously, 2009 to 2018, pretty much, we were well ahead as well, when other styles on top of growth were also delivering returns. Clearly, the Global Equity Fund is very active, as for those clients looking to take advantage of a fast-moving market and willing to take a lot of active risk. We also have a different solution, the Global Sustainable Equity Fund, that has got a very similar name, but a very different nature. It's a core solution, is a strong alternative to passive. It's low cost as passive, as diversified as passive, so it gives you that core global equity exposure. But unlike passive, there is possibility to outperform in the long run, thanks to exposure to styles again, quality, value, momentum. And it's fully systematic, this one. It's 100% managed by our partner Robeco, following a very similar strategy to that is owned within the Global Equity Fund, but a lot more risk constrained and a lot closer to benchmark sector and country weights. And is also sustainable in that it tries to achieve a lower environmental footprint than benchmark, a lower ESG risk, and an overweight to companies that have a positive impact on the 17 United Nations Sustainable Development Goals. Why is Robeco running this strategy? Why don't we diversify across sustainable and systematic managers? We think we don't need to in this case. Robeco are absolute experts in the field. They've been running quant strategies since the late 90s. They are very sophisticated in what they do. It's not just about styles, it's not just about quality, value, momentum. It's also about the way you define quality, value, momentum. The metrics, the portfolio construction can really make a big difference, and setting this solution apart from perhaps more vanilla smart beta solutions. But also Robeco take advantage of a lot of more nuanced signals like short-term reversals and measuring sentiment through machine learning and NLPs, as I mentioned earlier. They look at proprietary indicators as well as academic indicators. So there is a lot of diversification in the way these styles are achieved, and a big differentiator against competition. The result is a portfolio that is cheaper than benchmark, has a higher momentum, a stronger momentum, a higher quality, and lower sustainability risk. So a multidimensional all-weather solution, again, that is very different from the Global Equity Fund, however, because of its activeness. This portfolio has a 50 to 40% active share. It's on the high end right now, but active share is only one of the dimensions. Tracking error is much lower, is only 1.5% pretty much, which means this portfolio is never going to deviate too much from benchmark in terms of performance. The long-term track record is quite strong. The Sustainable Equity Fund was launched in 2020, but the underlying strategy this is based on has actually been live since 2004, and that's what you see on screen. We have delivered a net outperformance of about 30 bips per annum. That's after fees. I know it doesn't sound much, but it's been delivered with a very low tracking error, so a very high stability of these outperformance. And again, we position this as a strong alternative to passive. It's an active solution that is very risk managed and is pretty low cost. So it's another dimension of global equity exposure. It's been a long time here. I want to give the word back to Natalie, so I'm just going to wrap it up, perhaps highlighting these two solutions we've discussed about. They both give you a core global equity exposure, style diversified. Global equity is a combination of fundamental and systematic managers, and it gives you full exposure to the best-in-class 11 magnificent managers we own, whereas instead the Global Sustainable Equity Fund is just one systematic strategy run by Robeco. And also the Global Equity is very unconstrained, has some elements of ESG integration, but in a lighter way compared to the Global Sustainable Equity Fund, and is much more active, which means the potential for long-run returns is higher, but the variability, the volatility of these active returns is slightly higher, and the cost is accordingly higher compared to the Global Sustainable Equity Fund. Two sister funds, I guess, covering the global equity space. Both are high conviction from our perspective, although they serve different purposes. And with that, I'll finish off. I thank you very much for listening to us, and I'll give the word back to Natalie.
Thank you so much, Lorenzo and Andrew, for those insights. Valuable as always. And I'm sure the advisors on this call are now equipped to talk about all things global equity, including the investment opportunities outside of those magnificent 7 stocks. Our 2 Momentum funds, the Momentum Global Equity Fund and Momentum Global Sustainable Equity Fund, are great core equity solutions for your clients because they're exposed to some of those investment ideas showcased today. Yes, they do have exposure to the Magnificent 7 stocks. They are developed market equity strategies after all, but they are structured to also generate alpha in different ways. And hopefully you got some of that insight from Lorenzo today. What's more, we've now also got an emerging market fund. So if you're wanting to expose to both developed market equities as well as emerging market equities outside of what you've already got in your SA bucket, we've got a solution for you. Please chat to your investment consultant if you have any questions. Otherwise, thanks again for your time. Bye.